Welcome to today's Canary Report. Markets are consolidating as investors digest mixed signals from both corporate earnings and macroeconomic data. The tech sector is under pressure while defensive positioning begins to creep in. Let's see what our canaries are telling us about where capital is flowing next. The spec leaders show a fascinating divergence. ARKK rocketed up 2.3% today, clearly showing renewed appetite for speculative biotech and tech plays, while SPHB, the BlackRock balanced fund, dropped nearly 5%. This split tells us something important about risk tolerance at different levels of the market spectrum. The fact that MAGs and XLI both posted modest gains suggests that investors are selectively rotating back into growth names rather than taking a broad, buy-everything approach. Credit markets are showing surprising stability with yields declining across the board. High down 0.05%, HYG down 0.18%, and even HYW down 0.41%. In a normal cycle, falling yields would mean either reduced supply or increased demand. Given the corporate buyback headlines we're seeing, it appears institutional investors are actively deploying capital into yield-bearing instruments rather than sitting idle. The BALI strategy mentioned in our headlines, BlackRock's 7% yield approach, is clearly resonating with income-focused money even as growth sentiment softens. Here's the interesting anomaly. While the VIX dropped sharply to 1841, volatility proxies UVXY, VIXY 0.76, and VXX 0.77 pill all gained ground. This inverse relationship suggests traders are positioning for lower absolute volatility, but still expect movement. The news theme of tech dominating headlines, 11 mentions, combined with the semiconductor sector's 29% drop, indicates that fear is concentrated rather than systemic. Investors know where the pressure points are and aren't panicking across all sectors. The real economy indicators show more uncertainty. SMH, the semiconductor proxy, crashed down 3.29%, while IWM mid-caps gained modestly at 0.47%. This divergence between high-tech hardware and broader small caps suggests that the AI trade, once so dominant, is seeing profit-taking as some of the hotter-than-expected inflation headlines we saw earlier begin to digest. The Russell 2000's slight gain indicates that domestic-focused companies are holding up better than their global peers against what looks like geopolitical headwinds. Safety assets are quietly building strength. BOND up 0.6%, GLD jumping 1.41%, and XLP consumer staples climbing as well. Gold's outperformance is particularly noteworthy given the geopolitical news theme. Forbes and Shens suggest investors are hedging against uncertainty beyond just market moves. The fact that TLT, long-term treasuries, remained flat, while shorter durations, names like bond gained, indicates a flight to quality rather than a full-scale rate-driven rotation. We're seeing classic mid-cycle consolidation, growth sentiment cooling, credit demand holding steady, and selective defensive positioning without panic. The 800-point S&P target, mentioned in headlines, may be premature given the semiconductor weakness and geopolitical backdrop, but corporate buybacks at record paces provide a floor for equity valuations. Capital is rotating from broad tech exposure into more specialized income plays and geographic diversification, a sign of maturity rather than fear. That's your Canary Report for today. Markets are finding equilibrium after the AI boom and bust cycle we've been watching, with smart money positioning for what could be a longer-term rebalancing phase. Stay vigilant. Those 25% yield ETFs may not last forever, but this consolidation could be building the foundation for the next meaningful move.